It's a big week here with the Fed expected to hike at least 75 basis points, but the market pricing in a good chance that it could be more. As a result, we see risk off continuing on this Monday. Let's bring in Jim Bianco to kick off our conversation this week. He's the president at Bianco Research. Jim, it's great to have you here this morning.
Thanks for having me.
Okay, there is not a lot of news flow from the data here over the next couple days. And when we're in a vacuum in this market, is that a downtrend? What should we expect when there's nothing basically the next 48 hours between here and the decision by the Fed?
Oh, I think that, whatever trend was in place will continue. And obviously the trend last week in equities was down and the trend in yields was higher. And we're seeing that follow through on both ends today. We've got, futures pointing down on stocks, and you've got the 10-year yield making a new 11-year high just a few hours ago at 352.
What does that mean, the 10-year now getting back up above where it was in the spring and a decade-plus high, to your point?
Yeah, I think what people need to, or the way I look at it is the driver of the 10-year yield is short rates. With the 2-year yield at 394, or at least it was a little while ago, the yield curve, the difference between the 2 and the 10-year is minus 47 basis points. That is huge. The most it's been in the last 22 years is minus 54. So if you think that the 10-year yield is going to rally because the economy is slowing or something along those, a recession is coming, then you're going to have to make the case that the yield curve is about to do something that it hasn't done, or the Fed's going to back off. Now, the Fed's been pretty clear. They're not close to backing off. So as that 2-year yield keeps going up, because the Fed's going to raise 75, the market has already priced another 75 for November. It's going to drag the 10-year yield higher with it as well. Not as much as the 2-year, but it's going to, unless you want to, like I said, make the case, this time is different. We're about to see an inverted yield curve to something we probably haven't seen in our career. I'm not ready to go that far yet, so I think the path to least resistance is higher yields.
Jim, what's interesting in particular here over the last couple months is the yield curve flattening from the early summer, from June to August, basically, when the yield curve really pancaked. Stocks got a big rally. Apple almost went back to the highs. It seemed like we were really trading on the bad is good narrative. But what's interesting is the yield curve now is in the same spot, basically. I'm looking at the 10s to the 90-day rate, but most of them still kind of in the same range from the last month and a half. But stocks don't like it anymore. So did we finally lose that bad is good? Is bad bad? Is good bad? Is everything here bad?
Yes. What happened was the rally over the summer was the Fed was going to pivot. And let me be blunt with you, Oliver. Everybody tends to think the Fed cares about their portfolio. No, he doesn't. He doesn't care if you lose a lot of money. In fact, if you believe Neil Kashkari a couple of weeks ago, he was happy that the market got crushed off of the Jackson Hole speech. They want you poor, and they don't want to save your portfolio. And that's what the Fed pivot was about. And then people finally realized the Fed doesn't care about their portfolio. They only care about stopping inflation because it really hurts the bottom 40% of the population. And that's why I think it pivoted. The pivot went away, to be more specific, and yield started up and the stock market started to struggle right after Jackson Hole.
What do you think are the odds that 75 could be a baseline going forward? I'm listening to President Biden last night on 60 Minutes, and he doesn't sound concerned about inflation at all. If this is what the Fed's mantra is, with no pressure from the president, then what happens if they do decide they need to signal that they need to fight against inflation? Because I didn't hear anything about them feeling like they need to fight inflation in his tone last night.
Well, in his tone last night, I think that was all oriented towards the midterm elections, and he can't admit that there's a problem anywhere on anything. But to the Fed, I think 75 is the new baseline. If they hike 75 this week and it's 100% priced in, and the Fed has never failed to deliver on 100% priced in, that would be the third in a row. And it's priced in for November. That would be the fourth in a row. That sounds to me like it's the baseline if you've done 4 in a row at that point. Now, eventually, we're probably going to have to see these 75s end only because we're going to have rates at 375 in 60 days. And the Fed, I don't think, is ready to go off to 4.5 or 5 immediately, at least on the funds rate. So yes, you should expect 75. You should expect another 75. And there's been some joking talk that what Jay Powell should do at the press conference is reread the Jackson Hole speech. It was 8 minutes long. Just say, everybody, there's going to be no pivot. All I care about is inflation. I'm going to keep raising rates. Done. Questions. And that was pretty much the speech in Jackson Hole. Just reread it again, just to kind of get the point across.
And his Jackson Hole speech felt like a natural progression from his steps towards being more hawkish over the past year. But yet, this is when the market started to freak out. And then after the inflation print, too, you know, it's a response that kind of makes you scratch your head wondering, well, why were stocks rallying so much going into this number when there was plenty of evidence that when inflation would remain high? Jim, do you think the response here over the last month in stocks is just about positioning or a narrative that didn't work out? Or is there really a risk here that our inflation is going to stay at such a level that we are going to see some of these major structural breakdowns that some of the deepest bears have been warning about for a long time?
Yeah, two things. I do worry that the inflation is more structural, or persistent is the word I like to use. Look at the core number. That was 0.6% on the monthly basis for August. That surprised the highest guess on the street. Core is almost back to its year-over-year high with 6.3%. Its peak so far was 6.5 in March. There is a real problem. In fact, if you really want to be honest about the inflation numbers, you have falling gasoline prices, and then it ends there. Everything else is pretty much inflationary. But gasoline prices is big. It's falling a lot. It does offset a lot of inflation, but that's all you've got. It's 9% of the index. The other 91% seems to be a problem right now. As far as positioning goes, if this is a bear market, I'll just say this: sentiment can go to apocalyptic or suicidal levels before the market bottoms. People were talking Tuesday that the Bank of America survey came out. It showed that the most bearishness since 2008. And, oh, that's it. The market's bottom. Look how terribly bearish everybody is. And the bottom dropped out. I was like, if it was a bull market, you're right. Then that signal last week should have told you to buy. But do not underestimate how unbelievably bearish everybody will get if it is a bear market. And it's really hard to use sentiment to try and pick a low in a bear market because of just how extreme it gets. Remember how extreme it got on the upside. We said the word Tina for 5 years before the market peaked. And I remember when it first came out, the word Tina, everybody said, that's it, everybody's too bullish, it's got to peak. And the market kept going for years.
Great point. Really important point. Takes consensus to move price, right? Jim, I want to ask you about crypto before we let you go. Bitcoin down this morning. Ethereum's been getting blasted around the merge. I know you've retained a hope that the crypto disruption still has a place in the future in our financial system. What do you make of the recent action, and how are you feeling about your views right now?
Well, yeah, I think the word is in the future. The disruption isn't coming anytime immediately. Crypto does. The biggest problem crypto has is it's a risk asset, right? What is the big use case for crypto? Number go up. You buy it because you want the number to go higher. We need more use cases other than naked speculation. So it tends to be a risk asset. What crypto's telling us is what's happening in stocks and what's happening in risk markets all around the world is that there's a problem with risk markets and they're going down. It's just exacerbated in crypto. So I suspect that if the Fed's going to keep raising rates, if we're going to keep worried about inflation, stock market's going to stay under pressure, interest rates are going to go up, that's not a good cocktail for crypto either. It's going to be struggling. It just moves orders of magnitude larger than everything else.
Jim, always great to have you here, especially on a big week like this. Thanks a lot for joining us as always.
Thank you.
Pleasure. Jim Bianco, president at Bianco Research.